Coffee with Coker is a healthcare business podcast from the Coker Group that focuses on solutions to help healthcare organizations effectively navigate the changing healthcare industry landscape. All right, welcome back to another episode of Coffee with Coker. My name is Mark Reiboldt, and I am the host of this podcast. And today, I'm really looking forward to the discussion. We're talking about something new, something different from what we probably typically talk about. And we have a new guest here. I'll get to that in just a second. Before I do, as we usually do, a couple of housekeeping items, just reminders for everyone. We do appreciate you guys listening, subscribing. If you enjoy this type of information, this type of content, we'd love to hear from you. We'd love to encourage you guys to subscribe. You can find this episode along with all of our episodes on our website. You can get there at coffeewithcoker.com. You can also go to cokergroup.com. And you can find not only all of our podcast episodes, but you can get all of our white papers, articles, blogs, and a lot of other really helpful thought leadership on the business of healthcare. And that's really what we're talking about. And with that, I want to jump right into our discussion today and our guest. I want to introduce Mark Massey. This is the first time Mark is joining us on the podcast. He is from the Southern Medical Association. And I'm going to let him talk about that and a little bit about his background here in a second. But the topic that we're covering today is, like I said, something new, a little bit different, but I think it's something relevant to our audience out there, healthcare organizations, whether it's a practice or other type of ambulatory services, as well as hospitals and health plans. I think this is something that is probably going to be helpful information for you, and maybe new information and new ideas. So we're talking about cash balance plans, and again, this is not my area of expertise, so I'm going to let Mark talk mostly, and I'm looking forward to learn a lot from him. Mark, why don't you jump in and before we dive into cash balance plans, talk about the SMA a little bit and your background, and we'll go from there.
Sure. Thanks, Mark. The Southern Medical Association is a 501c organization that's been around for over 100 years. Its sole function is the education of people and the individuals in the healthcare business. Our membership is primarily made up of physicians, nurses, medical students, residents, some academia, and they come to us for educational purposes, i.e. their CE credits. We have a monthly publication, the Southern Medical Journal, and our library of podcasts too on, how to fix a slip disc or whatever it may be for that. So that's my sister company. Then we have the side that I run, which is the services department. And our function is to supply the income to keep the organization running for the next 100 years, and to provide products and services for our members that I go out and broker with organizations to get discounts, et cetera. How the organization started is kind of a funny story or unique story. Back 106 years ago, all our members were members of the AMA, American Medical Association. But the AMA was having all its meetings up in New England, and the physicians in the South, it's a long way to ride on a horse. So they decided to branch off their own organization so they could have meetings that people could get to. Having said that, though, of our membership, there's actually a bigger percentage now that is outside what I call the Southeastern Conference than it is in. So just because we say Southern Medical Association, we have members all over the country, actually the world, but mainly the country. So I want to have that distinction. Myself, my background is in qualified retirement plans. I was a 401k wholesaler for 25 years, 17 of it with the same organization. So my responsibility was to help people sell qualified retirement plans, primarily 401ks. I got the opportunity. I was doing a lot of business with SMA because we have, of the 22 different products and services we have under the SMA services side, the for-profit side. One of them is a TPA. And just so people understand what a third-party administrator does in the realm of qualified plans is what I call the I dotting and T crossing. We keep companies in compliance. I've got an ERISA attorney on staff who draws up the adoption agreements, which are the legal documents that you need in cash balance plans and any type of 401k, profit sharing, et cetera. Then we do the summary plan descriptions. We do all the required discrimination testing. We do the tax returns, which are the 5500s. And then in cash balance plans, they require actuarial work because they're a defined benefit plan. I'm going to get to that in a minute, the distinction in the defined benefit plan world. So when they offered me a job to run this side of it, well, for one thing, I wanted to get off the road. I've been on the road for 25 years, 3 or 4 nights a week, and I was worn out. But it also gave me the opportunity to not just, manage qualified plan administration, but a myriad of other things with group products, et cetera.
Yeah. Well, no, that's interesting. Actually, I never realized, as long as I've known the Southern Medical Association, I never realized that the reason for its original founding. So that was interesting. I like to hear that. And I do know there is a really long track record of just great content, information, education that has come out for literally decades from the SMA. And that's really what, we're doing today. I mean, that's what we try to do on this podcast. We're providing information and to a certain extent, education to our audience on a wide range of topics that are relevant to them. And so this is, as I said before, it's a lot of new stuff for me. But we get a lot of questions from our clients about things that are really out of Coker's wheelhouse from a services standpoint. But I didn't even realize until recently the resources of products and services that you guys have on your department, your side of the house at SMA. We're just talking about kind of one area of that today. But I just really want to encourage people to go and learn more about that, what you guys offer and do, and all the different things that may be relevant to them, because there is a lot. And it's pretty impressive. Yeah, I would say just start out by giving, even for my own benefit, but certainly for our audience, what are we talking about when we talk about a cash balance plan?
Yeah. And Mark, you made a comment earlier about new and in the world of qualified retirement plans, they are relatively new. The Pension Protection Act of 2006 had a lot of legislation in it, but many parts of that made cash balance plans in vogue, for lack of a better word. So they are growing at a rate of over 300% a year. They took a while to get legs. I was pitching them in 2007. And back then, nobody even knew, what they were. And they're still, like I do a lot of CE credit meetings for CPAs. And they've heard the term cash balance plan. They know that it's the best place to tax shelter qualified retirement dollars. And they want to learn more because, like anything else at new, they're a little complicated. Mm-hmm. But for those of you old enough to remember or work back in the 70s or 80s, companies used to have defined benefit plans. Mm-hmm. And the difference between a defined benefit plan and a defined contribution plan, which is a 401k, is in the old defined benefit plans, they were all employer dollars. Employees weren't putting money in like they do a 401k. And you were accruing a benefit for a future date. So based on your years of service, when you turn 65, you start getting a check, which was completely employer funded. None of your money was in it. And then at 65, you get whatever, $2,000 a month or whatever the benefit based on how many years of service that you accrued with that company and what formula they use to credit you for a year of service. So those things have been around. Those are the dinosaurs that everybody used to have. And frankly, I still have one from back then.
That's basically a traditional pension plan, like an old school pension plan. Yeah. And it's interesting because we still mostly older, like organizations that have been around for a long time, but hospitals and health systems still have active pension plans in place. And which is sometimes interesting to see, but sorry, I interrupted.
And if you are fortunate enough to work somewhere that has a defined benefit plan still, they are still the best thing going. But what's happened since 2006, and I could rattle off a long list of major employers that have switched from defined benefit plans to cash balance plans because they're easier to understand for the employees and they are less expensive. And allow employee dollars. And now I'll get into the distinctions here in a minute, the differences of them, but they're still out there. Anyway, back to the defined contribution plans. Defined contribution plan, as opposed to a defined benefit, which is saying you're going to accrue a benefit paid at a later date. In a defined contribution plan, i.e. 401k profit sharing, those plans you're accruing today and can take your money out at any time in the form of lump sum. Mm-hmm. So what cash balance does is it combines the two. And we call these hybrid plans because they look, act, and smell like a 401k plan, a profit sharing 401k plan, but have a lot of the rules of a defined benefit. So whoever invented this really had a great perspective in combining the two plans for simplification, expense, et cetera.
So talk about that a little bit more because, the hybrid description, I think, is really appealing to me. Talk about what are some of the characteristics of a cash balance plan, the types of funding is it employer funded? Is it, a contribution benefit, those types of things. Just get into a little bit. We don't have to get too far in the weeds on this because I'm sure it can get really technical, but I am curious and I want people to understand when we say a hybrid between those different types of models, what are we really talking about?
Sure. And as I go through those, I'll tell you how they look like a 401k or how they look like a defined benefit.
Sure.
So let's talk about funding. All dollars that go into a cash balance plan are employer dollars. Okay. So that's the part that's like a defined benefit plan. Mm-hmm. There are no elective deferrals, no employees, no employee money going in. It's all employer money. What's like a defined benefit plan is the rate of return. The rate of return in these plans is dictated by the adoption agreement. This is where, and I want to spend a little time on this before I move on to the next, because this is where some people get hung up because the rate of return is actually dictated by what the 30-year treasury bonds are paying. But they're down in the 2.17 range, which is hard to achieve a rate of return of 2.17. And they do give you some room around that return, not to go lower, but to go higher. Mm-hmm. So adoption agreements state the rate of return. For example, we use 4%. That's what almost everybody's going to use. If you don't see a 4%, it's going to be 5%. So you could go to every employee and give them their annual statement on New Year's Day, because we know what the contribution is going to be because it's a fixed contribution that the employer puts in, and we know what the rate of return is going to be. It's going to be 4%. And why I say some people get hung up on that is they'll say, well, 4%, I can earn 3 times that in the stock market. Okay, well, you're going to be able to put $300,000 in it, and you're limited in what you can put in a 401k plan to either $61,000 or $67,000, depending on your age. This is a way to get additional funds in and save significant tax dollars. But the rate of return is established. Okay, so 4%. And I'll come back to that. Another thing that's similar to defined benefit plans, or exactly the same for that matter, is it's a pooled account. So when the employer makes the contributions, it's all in one account managed as one, as opposed to a 401k plan where You get handed an enrollment book and there's 20 different mutual funds for the employees to choose from, and they pick, what they want to, and so forth. This is one, because remember, and this is where, from our perspective on our side, we have to do a really, really good job, is trying to keep that rate of return as close to 4% as we got. And some of the partners we use that manage the assets in this are like, this is tough, particularly when the market's doing well, because we certainly don't want to earn less than 2%, because if you earn less than 2%, then the employer has to cut a check to get it up to at least the 2% level. And you don't want to earn too much over 4, because the more you earn over the 4 decreases the deduction for the employer, which is why they bought it to begin with, is to reduce taxes. Sure. So you've got a balancing act there of trying to put together a portfolio of assets to return in that 4 to 5%. But it's not the end of the world if you, let's say, accidentally earn 7 that year. You can amortize over a 15-year period the difference in those returns, so you can still keep your deduction valid over a 15-year period. And I don't want to get too much in the weeds with that, but what you certainly don't want to do, and I see this too often, unfortunately, when I look at an existing cash balance plan, is somebody invested them in equities, stocks, bonds, and started 12, 14%. Now it's defeated the purpose, because you only buy a cash balance plan if you're looking to get a greater tax deduction that is allowed under your existing 401k plan.
Yeah. Well, I was going to go into that, because I know something that's very relevant for a lot of our clients, and this sometimes comes up, not our area of expertise, but is the tax treatment on things like this, or the options out there for deferments and deductions, et cetera. And so how does that work from a tax standpoint, both the employer and the employee, particularly in comparison to some of the limitations of a 401k?
Yeah. And the best way, or the only way to explain this without talking for hours, is to pick an age of an employee. And so I'm going to take a 55-year-old employee. And when I explain it from the employee's deduction perspective, the employers, all the contributions they make into the cash balance plan are a deductible expense to the corporation. Okay. Most of the people who buy these statistically across the country have 20 employees or less. And, they could be a family-owned business or a smaller group that's got highly compensated employees that have tax issues. And so they're trying to reduce their tax burden. So they're really killing 2 birds with 1 stone, because they're reducing their individual taxes and their corporate taxes. But let's just say that you've got 2 55-year-olds who are earning $500,000 apiece, just to pick a number, under a traditional 401k. And let me stop there. You would never even consider getting a cash balance plan unless you already had an existing 401k. Sure. Not just a 401k, a 401k safe harbor plan using the 3% non-elective. And I can come back to that in a minute. But to go on with let's just say for simplicity, you got 10 employees and you're trying to benefit the 2 owners who make $500,000 apiece. Under their safe harbor 401k plan, they're limited, because they're over 50, to $67,500 each. Okay. In a cash balance plan, we can take that up to $289,000 apiece, because the cash balance contribution for a 55-year-old is $222,000. So right there, and let's just say, to make it even a better story, that it's a husband and wife. So if they can put $222,000 each, which is $444,000 additional dollars away for retirement, then they've saved $150,000 in taxes, maybe more, depending on what tax bracket they're in, what state they live in, et cetera. So this is strictly you purchase these, to save money on taxes. And look, what I'm going to say next is a Mark Massey opinion, not a something you would find written in any type of educational material from the IRS or DOL. But in my opinion, for an individual to afford to save, because when you combine the 222 with their underlying plan, we're talking about $289,000. So let's just call it $300,000 for simplicity. In order to afford to save $300,000 a year, you got to make at least 500.
Mm-hmm.
I mean, let's just keep it real. I mean,
right.
Got to pay your bills and everything else.
Right.
And I run across people making $1 million that have a lot of off the field baggage and, toys and secondary residence that still can't do it.
Sure.
But when I'm talking to companies who approach this with me, there's two things I always ask them. First thing is, do you expect your company to be profitable in the next 3 to 5 years? Uncomfortable question. A lot of people don't like to ask it, but I do because I want to know. Because if they say no to that, this just happened last week, then to me, they're not a candidate for it, because unlike profit sharing plans, where in profit sharing plans, you throw in additional funds if you have a profitable year, these are defined benefit plans. So you have to make contributions. Now, you can always, the government never cares if you discriminate against highly compensated employees. So if you did have a tough year, the example I use, the husband and wife just don't make the $222,000 contribution apiece or make a lower amount.
Sure.
But for your other employees, you have to fund it.
Yeah.
It's a DB plan. There are some exceptions. 2 out of every 5 years. Well, actually, now they've increased that to where under hardship circumstances, you can skip years. But again, why would you purchase a plan that you're going to skip years and pay fees for that you're not utilizing? So to me, there's two things I always look for. First off, is it a company that expects to be profitable in the next few years? And secondly, can they afford it?
It's interesting that hypothetical that example you walked through, because obviously, Coker, we work with a lot of large hospitals and health systems. And I'll come back to that in a second. But, that clearly that's not the primary demographic organization that you're talking about. However, on the practice side, which of course we work with a lot of practices as well, what you just described is a very common arrangement for practice, even down to the husband and wife thing, because a lot of times you see that husband and wife pair of physicians, or one runs the practice, one's the physician, whatever it may be. But that size that you're talking about, the overall employee size and the level of compensation, and the fact that they are always looking for different options for tax treatment as well as retirement and saving options. So actually, I think that's extremely relevant for a lot of our folks. Maybe talk about that for a second, based on other than what you just went through, the profitability and the can they afford it? Who else is a prospect here?
And before I move to that, I want to be clear on something. I picked that as an example because there are no brainers there. I mean, it just is. When I put an illustration in front of somebody and they look at the numbers, it's like, why wouldn't I do this? And it's always, well, it depends on if you can afford it or not. But I'm going to use, without using names, I'm going to use a different example of one I'm working on currently. And this is a group of ENT physicians that have 15 physicians, 12 of them are partners, and 155 other employees. Well, one of the beauties, and this is a good example to illustrate how it works for larger companies. And look, there are even major companies like Federal Express, Delta Airlines that have switched their old DBs to cash balance. But when you get in those major, I don't think we're going to have audience with 10,000 employees or more here. So I'm trying to keep it to where I think the audience is going to be.
Sure.
So when you have a group like that one I just described, you can classify the employees in different groups. So the way we're setting that one up is you have Group A, which is physician partners. So there's 12 people in that group. So based on their age, they all get the max. So if you had a physician who was 60, they get a contribution of $258,000. If you had one that was 50, they get a contribution of $173,000. So it's all based, because contributions are based on your age. Every year, a table is put out by the IRS that shows your ages from 18 to 80 and the amount that they can get in cash balance. So the numbers I'm all using are numbers for 2022. So Group A, physician partners, we get them the max. So let me be clear. My actuary and anybody's actuary works backwards to figure out how much the total contribution is first to give the 12 physician partners the maximum contribution. Then we set up a Group B. Group B is physician non-partner. And that group were designated to get 12% of pay. That could be any number, but I'm just giving you a live example. So the physicians that aren't owners, they're still getting a 12% of pay contribution, which is a tremendous contribution. And then it also gives them an incentive to make partner, because then that jumps to even a bigger number. Then Group C is everybody else, the other 154. Now, how much do you have to give to rank and file employees in order to pass all the rules to maximize the top group? And that's where, again, you work backwards. But here's what I tell people, and I'm going to tell you why in a minute. You have to be willing as an employer to give your employees a benefit of somewhere around 8 to 12% of pay between the 401k and the cash balance in order for these to work. And it's usually, in a perfect world, it's 8%. And when I say a perfect world, here's where I'm going to have to get just a little bit in the weeds, but it's important. So it all starts with your underlying plan. You've got a 401k plan, safe harbor. And the reason why you have a safe harbor plan is to get rid of discrimination tests so the highly comps can maximize their contributions. And you have what's called the 3% non-elective, because safe harbor plans have two required funding mechanisms to choose from. And most of the plans I look at have the match. And then I immediately change them to the non-elective if they're going to be a cash balance candidate. Because if you have the 3% non-elective in your safe harbor plan, they'll allow you to count that towards your cash balance contribution. I call it double dipping. Okay. So I always will change the match if they have that in their safe harbor when I take them over to become a 3% non-elective, because now I can count that 3% towards the cash balance, because the rules in a cash balance require that you give your employees at least 5% of pay. So if I've already got 3% of it under my underlying plan, now I'm only at 2%. Now, how to determine the percentage that Group C gets, 150, is based on the average age spread between everybody in Group A and everybody else. So if it's 15 years or more, you're hitting the minimum, which means you only got to give them 2% in that cash balance. We got to give them 5%, but you've already done 3% under the safe harbor. So now it only costs you 2% more to give all these partners $250,000 extra dollars. So these things don't always work. Now, if it's 10 years, it's still nice. The lower it gets, and when I say average age spread, it's as simple as it sounds. You line all, in this case, the 12 docs up. This one's 62, this one's 47, this one's, and then you divide it by 12, and you take the other 150 employees, and they, of course, have a myriad of ages, and then you divide it by 154, and you got, here's your average age, and here's your average age, and then you look at the spread. Mm-hmm. Now, in the medical industry, this works well quite often because the physicians tend to be older than their employees.
Sure.
It's just a fact.
Yeah.
Spent a lot of time in medical school, residency, before they even spun out. You see where I'm going with this?
Absolutely. Well, that and that example, the ENT practice is a very good one, because again, we see that all the time. We work with those groups all the time. And that right there is a perfect example of perhaps giving some of those options that they're either not aware of or didn't have access to previously, but also being able to benefit, more than just the partners. And I think that's important. It's becoming more increasingly important, whether they're a non-partner clinician or a non-physician clinician, i.e., a APP, a nurse practitioner, et cetera. And then the business staff. And those options are becoming increasingly important. And I want to circle back real quick too. Sorry to bounce around a little bit, but I talked about the relevant, how this is relevant for particularly practices like that example of an ENT group that you mentioned. But I want to speak specifically to our audience that come from the hospital side, and specifically folks that are dealing with, not dealing with, but working with their community physicians and the practices in their community, whether it's their own physician enterprise, whether it's an employed group, a CIN, whatever it may be, or just practices that are in the hospital's community. And these folks are always trying to find ways that they can help the physicians out in a way that is obviously ethical, legal, compliant with all regulatory requirements and limitations, all of that stuff. But, how can they continue to help their physician partners, their medical staff, et cetera? And, this is one of those things that even just from an informational standpoint, I think could be a nice resource for those people, because, the hospital may have zero involvement in doing this, but providing those options, that's only going to further endear those providers with that organization, I think. And those types of relationships are extremely important and even vital in these communities, and particularly as competition continues to grow, especially within urban areas and suburban areas, and the way healthcare dynamics are unfolding with all the affiliations and stuff. I think this is something that is worthy of that consideration. So, and you may see some of that, but I think this could be that a little bit more subtle, even behind the scenes.
Totally agree. So there was a lot in there. So let me unpack it a little bit.
Mm-hmm.
And some of this I know but I want to make clarification for our audience. In order to participate in the scenario you used in the plan, let's say for the hospital, you cannot be a 1099 employee. Okay. Yeah. It has to be a W-2 employee, but you were coming at it from a different perspective. You were coming at it from the educational side, like we are today. This is what this is about, is educational.
Correct.
So let's just say that you had an important, cardiologist that was, that did a lot of work with your hospital. And it was just the cardiologist and let's say 2 or 3 employees. I mean, these are like slam dunks for them because they're going to load up the contract. So they might have a total payroll. Now, any compensation and any type of qualified plan above $289,000 is not recognized on any type. I mean, it's recognized you got to have the money to fund it. But once you hit 289, it doesn't matter if you're Bill Gates, Warren Buffett, Elon Musk, it doesn't matter what they make. Everything is capped at 289.
Yeah.
So you might have an eligible payroll, and just for simplicity, let's call it 300 because it escalates every year. And then they have 2 employees that make $50,000 each. You've got a total payroll of $400,000, and the physician, let's just say 60. So they can make a cash balance contribution of $258,000, and then give 2% each of 100,000. That's so 2,000 for the 2 employees and 258. That's like 99% of the money. I mean, what they would have paid in taxes. And see, every time we do an illustration, and this is all about illustrations, whether if it's us or any other TPA that you look to because you have to look at the numbers to see if they work.
Sure.
When we do an illustration, we always have a graph. It says percentage of money going to key employees, highly compensated employees. And when I say that with love. Yeah. I'm using words that are IRS words, not Mark Massey words. Sure. I mean, everybody's important in the organization, but the IRS have these terms they use to distinguish employees into groups. Mm-hmm. But anytime you can see a graph that shows a percentage of money going back to the group you're trying to benefit the most, that's a bigger percentage than they would pay in taxes, I always get back to the final question with them. Do you want to pay Uncle Sam 35%? Or do you want to give your employees 10% with a 6-year vesting schedule on it? I mean, that's what it comes down to.
Yeah. Yeah. And when you start to look at those numbers, I'm sure for each individual organization, they can probably get pretty compelling.
Right. And if it's not, we're quick to say, people, this one just doesn't work because your ownership and your key people are because of their ages. The only way the government stumbled into allowing something this nice to happen, and this is just my opinion, because usually plans are totally skewed towards the lower end. This is the only thing out there to really tax shelter a lot of money in, is they're saying what they call facts and circumstances, that older people have less years to accumulate dollars for retirement. So they develop this plan skewed to them so they can kind of catch up. Yeah. Because they don't have as many years left to accumulate as the younger employees. Sure. I want to talk about a few other important characteristics, though, the differences between a K and a defined benefit plan, because there's some other important things. And to me, one of the most important is portability. In a traditional defined benefit plan, when you left a company, for example, the company that I talked about earlier that I worked for selling Ks for years, when I left there, I didn't leave with a lump sum of money. I left with a promise. And then every year I get a statement going, if you start taking your pension at 62, 63, for all the different years, kind of like the Social Security statement you get. Sure. I'm receiving a benefit later. Cash balance plans work different. They work like 401ks. When you separate from service or have death or disability, but let's stick with, for simplicity, the most common reason people leave is they go somewhere else, voluntarily or involuntarily. Mm-hmm. In these type plans, then what they do is they establish what your portion of the pooled account is. Let's just say it's $100,000. Then you can either take that money and you could take it in cash if you wanted. Of course, if you're under 59 and a half, you would incur a 10% penalty. And then Uncle Sam hadn't been paid yet, so you'd have to pay taxes. You lose 30% of it in penalties and taxes. Yeah. So that's the least favorable, but at least you had the money. Yeah. And something happened. The second way, most common way, is you can roll that money into your next employer's 401k plan. So unlike your DB plan, you've got control of your money now. Or C, if you you certainly wouldn't want to incur the penalties and taxes. Your new company either doesn't offer a 401k plan or the investments are not to your liking. You can roll it into an IRA. So the same rules apply as a 401k. They're portable and you can take them job to job. Very important distinction. And then defined benefit. And then that money just becomes part of the 401k or the IRA, depending on the scenario. It's just a part of that account now going forward and under the same requirements. It's not treated any differently than your 401k balance unless your 401k has Roth contributions in it, because those are after-tax dollars. So you'd have to have I call everything buckets of money. Yeah. You'd have a separate bucket for your pre-tax and your post-tax, because all dollars in a cash balance plan are pre-tax dollars, meaning Uncle Sam hasn't got paid yet. That's right. So that's an important distinguishment between the two. Another important factor is in cash balance plan. I shouldn't say important factor, but a difference or a factor is you can have loans in a cash balance plan. Just like a K, not required, but the employer has the option for an employee to take a loan. Certainly can't borrow from a defined benefit plan. So that's a difference too. Also, The vesting schedules are different. They're a little quirky. So in a 401k, you have a plethora of different vesting options you could choose from. On the cash balance, they're 3-year cliff vesting, which means an employee has to work for the company for 3 years before they get the benefit. In other words, if they leave voluntarily or involuntary at the end of 1 year or 2 years of service, they get 0%. And those monies come back to the corporation to either split up between everybody else or to use to offset future expenses. And then once they work the 3rd year, then they become 100% vested.
Mm-hmm. Gotcha.
Because a lot of 401ks have a graduated schedule where you get,
I'm familiar with that. Just doing our own here. That portability and the loan point, I think, are very interesting because I think those are becoming. I don't know if they're becoming more popular than they were, but it seems like you hear more about that for whatever reason, whether it's a tax thing or whatever.
Can I give you a quick example on loans?
Please.
Because this applies to 401k plans. So we saw a lot more 401ks than we do, or administer a lot more 401ks than we do cash balance, because not everybody's a candidate for cash balance. But the loan question always comes up. And inevitably, I'm in a conversation with either the CFO, CEO, owner, whoever it is, about, do you want loans in your 401k or your cash balance? And their immediate knee-jerk reaction is, no, I'm afraid my employees will take a loan and go to the casino tonight or buy a boat or whatever they say. The maternalistic issue, and I get it.
Yeah.
But let me give you an example that I just used recently to where loans can really be favorable. So I had a lease on a vehicle that expired. And, right now, for whatever reason, used cars have gone up.
Yeah.
And when I leased this 3 years ago, with any car, there's a residual amount that you can, pay off the car for. So when I looked at the residual amount at the end of the lease, because normally when I lease cars, I just take them back home, the keys, leave, and go get something else.
Right.
This time I took the time to look at it and what the car for me to pay for it was, and what it was going for on the open market was a $12,000 difference.
Yeah.
So rather than take, in this case, 18 grand out of the market or any of my investments, I take a loan, pay the car off, sell the car the next day, pay the loan back the next day. Loans are 0 interest loans in these type plans, by the way, too. So I flipped $12,000 without having to take any money out of the market. There's a lot of creative things with loans that people don't think about. My point.
That's a great example. And that's kind of why I was thinking about it, because like I said, I don't know if they're becoming more popular or people are starting to use them a little bit more creatively, exactly like what you just talked about. And I think there's even more practical stuff too, with, having gone through COVID and pandemic and the ups and downs and uncertainty of a lot of folks' businesses. I think that's become one of these options where, it's whether it's a temporary stopgap or, an opportunity to take advantage of something like that. I've heard of those exact same scenarios. In fact, I know someone that did that same thing. They bought out their lease for what ended up being almost pennies on the dollar compared to what they was ultimately able to sell the car for, and then go and he just bought something different, at that point. So all that arbitrage, he still came out, very much on top.
Yeah. And without the key being not having to touch anything other investments.
Yeah, that's right. Yeah.
If nothing else, it's a hassle.
I'm sure it's definitely some things that have to be moved around, but hey, listen, for $12,000 essentially overnight, that's not a bad consideration.
There's one other key point we haven't hit. One thing, this is the last differentiation that's germane. That's in a cash balance plan, because they are defined benefit plans, you have to have insurance through the Pbgc, the Pension Benefit Guaranty Corporation. The premiums this year, $88 a participant. Okay, so there are additional costs in a cash balance plan. Now, there are and there is an exception to the Pbgc rule, and that's if you're a professional organization that has 25 or less employees. That would be, they waive the Pbgc premium. Like if your company has 25 employees, but assuming they had under 25 or less, your professional organization, you wouldn't be subject to PBG. We have to look at that on an individual basis, but sure, that is to guarantee the plan, the benefit payments to, because we talked about the portability and lump sum, but one of the beauties of a cash balance is you can do it just like the traditional pension. You just let the money sit there and it'll accrue a monthly benefit and pay you out a pension. If you prefer it that way, that's still an option.
Yeah.
But having options of cash rollover, to me, just the more options, the better.
Yeah, I completely agree. And it sounds like, I mean, again, I think it's something that could be a really good option for, like I said, a lot of the folks that we work with of all size of organization. And, this is, I'm going to bring us kind of full circle here and close this out, because we kind of alluded to this at the beginning of the discussion, but there's a lot here. There's a lot to unpack, particularly if this is something new to people. I think most professionals have some sort of familiarity with the 401k side and even have dealt with that in their organizations, most likely. This is another option, similar, but as you've outlined, some key differences and I think those are very important to understand. But there's a lot to do with these. There's a lot behind them. Like you said, I think folks really are going to get their answer when they look at these and put numbers, pen to paper, and really figure out what the impact or the potential opportunities are. And so I would just encourage folks to, this type of information, we've just grazed the surface. But if you are curious, if you'd like to kind of understand a little bit more, you guys have a lot of really good information on this and all of the things that you guys do, products and services wise. A lot of really good information. And at the end of the day, I think if they want more, they could reach out to you, point people in the right direction as far as where to start. If they said, I'd like to learn a little bit more about that.
Well, my email address is mmassey, that's MMASSEY @SMA.org. And I would be glad, because again, just like you said, these are not for everybody. You get, and quotes are free. And when I say quote, I don't want it to sound like it's either going to fit or it's not. Yeah. I mean, the numbers speak for themselves. But if you want an illustration, that's a better way to put it, an illustration to see if that would fit, you can email me, or I don't mind giving out my phone number. If people just want to call and talk about this. It's my cell number is 901-355-2559, and I'll be glad to hit it. The only thing, there's one thing I did miss that I want to discuss, and it's not that big of a deal, but it's worth saying. There is a lifetime benefit limit that they have in these, because it increases every year, but this year it's 3.1 million. So when we write these plans, we have to write them to what's called sunset. And the idea is to sunset when all the people you're trying to benefit hit 3.1 million. I'm telling you though, this thing is escalating quicker than it used to. I mean, it was 2.7 last year, 2.7 or 2.8. It keeps jumping, so it's pacing good to where they'll last a while. But I did want to put that out there that Uncle Sam does turn the faucet off eventually. But as far as information, look, the best way to do is just, if you wanted to see if it fits for your company, we just need a census, dates of birth, dates of hire, and incomes. And then, of course, income, anything over 289 doesn't matter. And then we run it and you look at it and see if it makes sense. And if it does, then you can proceed. And if not, then, but when it works, it's beautiful. And I can lay out every time I do one that I send out that, it's very common for 90% of the money to go to the people you're trying to get it to. Very, very common. Mm-hmm. And I'm thinking this is a no brainer. They're going to jump all over this. But the thing is, these are big checks. You have to be able to write that check. So,
Yeah. And, that I think that is a good point. Like you said, if if it works beautifully.
Right.
And I think that's something at least worth learning more about for the right candidate. So that's extremely helpful. And I will make sure all the contact information for you and the SMA and all the other products and services you guys offer is in the description to this episode. So folks don't have to, they can go there and just get that directly. But other than that, I really appreciate, I know, Mark, you go all over speaking at conferences and doing presentations like this. So I appreciate you sharing this with us. Again, I just want to encourage folks to follow up with you or the SMA as far as getting more information, because you guys do have a lot of really good information on these and other things. So I appreciate you joining us. And I'd love to continue the conversation and talk about some of the other things that you guys are doing and seeing out there that may be a benefit to our audience. So I look forward to having those discussions in the future.
I want to say one more thing.
Please.
You could say this is where you heard it first, is it's just passed the House, I guess about 10 days ago, 496-5. It's going to go through the Senate just as quick, just as bipartisan, and Biden's going to sign it. It's called Secure Act 2.0. And we can have a different conversation about that, because it's still got to go through the DOL and the IRS, because they put some stuff in there that the IRS is going to say, you lost your minds, we're going to have to scale this back. But the main thing about this, because one thing that's for sure not going to change that's coming, is auto enroll 401k is going to be starting next year for everybody in the country that has over 10 employees, where you have to automatically enroll your participants in a K plan. So that's coming. I've known it was coming for years. It's finally here. And that would be worthy, whether if it's me or one of your other partners, in the coming months when they start dotting their I's and crossing their T's on what this is going to look like. Because I've been selling auto enroll plans on a voluntary basis for years. And I always tell people there's a big morale hazard embedded in this when you start taking money out of people's check, without them fully understanding how this works.
Yeah, sure.
People are going to want to get in front of this.
Yeah. I like that. It's a teaser for the next discussion. So we'll look forward to talking about that as more information comes out. So I appreciate you bringing that up. And like I said, I really do look forward to talking about that more in the future.
Great. Thank you for your time.
Thanks, Mark.
We hope you enjoyed that episode of Coffee with Coker, and we thank you for listening. We want to encourage all of our listeners to participate and contribute in the podcast. So if you have any questions on any of the things we discussed in this episode, any of the topics that were presented, please feel free to ask us. Also, we welcome your feedback and suggestions. If you have any ideas related to the material we discussed in this episode, or in any episode, please let us know and we'll make sure to incorporate it. And if you have ideas for topics you'd like to hear more information about in future episodes, please send those suggestions to us. We would love to hear them, and we'd love to incorporate them into our future episodes. You can find us online and on social media. Start with our website, and specifically the podcast is coffeewithcoker.com. You can also find that through the main Coker website at cokergroup.com. You can also find us on social media, Twitter at Coker Group, and then on LinkedIn, you can search for Coker Group and find our page and the page for some of our team members as well there. So you can find us and reach out to us in a number of places. And then if you want to contact us directly, one of the best ways to do that, email feedback@cokergroup.com. That's feedback@cokergroup.com. And again, we'd love to get your feedback. And we'd love to encourage everyone to subscribe to the podcast so that you can be notified when future episodes are released. We look forward to the next episode, and we look forward to getting your suggestions and feedback on this episode. Thanks for listening, and we look forward to speaking with you again on future episodes.